Namaste. Hello. This is Abhinav, and in this video, I am talking about a very specific taxation, which is of incentive stock options in US and India, and specifically with respect to employees who are returning back to India, right? Especially tech workers who get the ISOs and who return back to India. How the dynamics will play out. Now, just a disclaimer. I am not very deep into the ISO taxation. It's a very complicated area of the US tax law. There are dedicated CPAs and advisors who only practice in the equity compensation, stock compensation. So ideally, because the stock compensation becomes a big part of the portfolio, you should contact them because there are scenarios that need to be run as to whether to exercise, whether not, when to sell, all that. There are multiple tax strategies. So better you can contact them and get the proper advice. This is just some basic points that I'm trying to share, right? Okay. Now, before talking about the taxation aspects, please understand that exercising of the ISO, so company will give you an ISO, it's part of your compensation, but whether to exercise it or not depends on what is the your perception of the strength of the company, right? It's basically an investment decision first and a tax decision later. If the company, you do not believe in the strength of that company, then it may not be a viable thing to exercise, right? Or there are other strategies that you can deploy. I've seen in portfolios where the a very significant chunk of the portfolio, around even 70 to 80%, is into ISOs, which is exercised ISOs, right? Which is shares, and the person ends up buying, exercising the shares, and he has not sold. So he ends up buying 70 to 80% of the portfolio in a one company. That is the concentration risk, and it's a very big risk, must be avoided. Because think of a case like Satyam. What happened is that the day the Ramlinga Raju announced that there was a fraud in the company, I think 95% of the fund, the share value had eradicated, right? So you don't want to end up in that particular situation, right? Better to have diversified basket of funds. Best is to avoid, is to invest in a kind of low cost index funds. Yes, when you sell, there is a capital gain tax implication that will arise, and but still you have to find ways to diversify your portfolio. I'll make a separate risk on how to separate not separate risk separate video on how to diversify and avoid the concentration risk in the portfolio. uh, yes, let's come to the ISO taxation in US. Now, ISO is basically uh, is kind of a tax preferred as compared to NSO. So there's ISO, there's NSO, two types of options. NSOs are not that tax efficient. ISOs are tax efficient. Now, in ISOs, there is no tax at the time of exercise. There is a AMT that gets triggered. AMT is what? AMT is a parallel tax system. So one is the regular tax calculation you do, that okay, this is in ISO. There is no tax on the exercise, but there is a separate calculation under the parallel tax system. If you exercise a large chunk of ISOs, a AMT, alternate minimum tax, can get triggered. You'll have to pay that alternate minimum tax, right? And that you can recoup or claim later on in later years. So it's not like money that has gone. You have the opportunity to reclaim it in later years. In ISOs, the tax arises at the time of sale, right? So whatever is the sale value minus the strike price is taxable at the time of sale. So this is very good. So again, at the time of sale, there are two things. One is a qualifying disposition, another is a non-disqualifying disposition. Qualifying disposition, the rule is that when you sell after 2 years from the grant or 1 year from the exercise, and 1 year from the exercise, if you meet both conditions, then it's a qualifying disposition. The taxation is as per long-term capital gain, which are the preferred rates, 0, 15, 20%, right? Second is a disqualifying disposition. That means if you don't meet any of the conditions of these two conditions, then a disqualifying disposition, which is more or less the taxation happens similar way as a NSO. That means fair market value minus the strike price, taxable as per the ordinary income tax rates. And then there is a certain capital gain component as can be there as well, right? So people generally try that they meet the qualifying disposition criteria, and then they have a long term capital gain. But then I've seen they don't end up selling those, and they have so much belief in that particular company, and they don't sell, right? Which is, I think, that's not a good idea. Now, let's come to the ISO taxation in India. Now, think about a situation wherein the person got the ISOs and he's working in a company, and he gets transferred to an Indian arm of the US company, which still continues to give the ISO as per their vesting schedule, right? So how will the taxation work? Now, cross-border taxation of options is a very litigative area as well as a complex area. I'm telling about the general law. So the India US DTA does not specifically address this particular issue of cross-border taxation. However, if you read the OECD commentary on the Article 16 on the dependent personal services, there is a specific mention of such a situation where the person comes back to India, and then, so what the OECD commentary states and the position it takes is that the taxation will be allocated to US and India basis the mandates allocation. So for each vest that happens, for each vest of, or for each exercise in case of option, you need to ascertain what is the period of service that was rendered, right? So so today if I get a salary at the start of the month, right, or at the end of the month, it's for a particular month. Similar for a vest, it's for a, it relates to a particular period. Now, out of that period, suppose 365 days, 300 days were pertaining to the period of services rendered in US. Only 65 days were rendered in India. So whatever is the income, it gets allocated 300 is to 65 is the ratio. 300 divided by 365 into the income taxable in US. 65 divided by 365 is taxable in India. So this is the OECD's position. Now, this is not binding on the courts, on the Indian courts. However, Indian courts have, in many cases, taken the position that is given in the OECD commentary in terms of their decisioning. So, it can be substantially relied on. Right now, in India, there is no concept of ISO NSO. So India will tax this income as per the Indian tax law. Now, Indian tax law, there is a specification about ESOP, employee stock option. That's it, right? So how the ESOP gets taxed is that it is taxed on exercise, FMV minus the strike price, like that of a NSO, right? So it will be on exercise. Now, please understand here, the ISO does not get taxed. It gets taxed under the AMT regime in US, and you need to pay the AMT, right? If the AMT tax is more than the regular tax. In India, it's not the case. In India, whatever is the FMB minus the strike price will be taxable to you at the exercise stage with respect to the Indian days, right? That is one thing, right? Okay. And it is taxable as income from salaries at slab rates, right? Now, options exercised during the RNOR. Now, if you exercise any ISOs in the RNOR stage, you may say that the income was earned in the, it's a, like I'm in the RNOR, it should not be taxed. No. So India says that as per Section 9, income deemed to accrue or arise in India, it's basically any see, this is compensation that you receive with respect to of the India tax portion, India allocation portion. It is services rendered in India which is taxable in India irrespective of your residential status. So even within our NOR, if there is a specific India allocation in the, so you need to calculate for each vest. It's a complex calculation. Better you should give it to a CPA who understands this area, maybe one of the big fours, or in the lower rung tier 2 firms who understand this thing, and then ensure proper US and India compliance, right? So yeah, so even in our NOR it is taxable. Please understand that. Even after our NOR, now you can follow the same approach. So the general rule is that after ROR, India has the right to tax the complete income of the person. However, you can go by this OECD commentary and say that okay, only the India portion will become taxable. However, this will be tax litigative. The Indian tax authorities can come back to you and say that no, the position should be that you should have offered the complete income to tax in India, right? And then you could have claimed a credit of the US tax that you pay. So that will be slightly doubtful, right? On both options you can exercise, right? Okay. Now, after ROR, you need to make sure that one is that you need to disclose all the foreign assets, but even if for the unexercised ISOs, the ISOs that you have not exercised, if they have just vested, right? But you have not exercised, even those need to, because a right to participate in an asset is actually also an asset. right? So even the unexercised, as a best practice, you should disclose in Schedule FA, and whatever is the income, depending upon the India mandates allocation, you should disclose in Schedule FSI. It's mandatory. If you don't do, there is a flat 10 lakh penalty. So you need to keep in mind. Now, if you have exercised the ISOs after return to India, you already have exercised ISOs. If you sell them, it will be tax free to you as a US non-resident, provided you have submitted W8BEN to the US brokerage, right? But if it's RNOR in India, not taxable. But if it's ROR, it will be taxable. If it's long-term capital gain, 12.5%, short-term capital gain, slab rates, right? When you exercise, so it is not taxable in US if you file W8BEN, spent less than 183 days. Please also take into account that you should take the funds in the US bank account and then you remit it to India rather than directly remitting to India. AMT credits I discussed, it can be carried forward indefinitely. Now we come to the issue of recouping of the AMT credits. So suppose you have paid the AMT credits and you were under an impression that okay, I have paid it now, but at the time of selling of the ISOs, or at the time of any other US source income, I will be able to recoup those credits, and that's the how it works. But the problem is that once you become a non-resident, this is the specific problem that comes, is that when you sell the shares, right? So those shares are non-taxable to you in US, right? Because US doesn't tax capital gains for non-residents, so you do not have US source income to that extent. Second is, as a non-resident, if you see the final wording of the law, it allows the AMT credits to be recouped only from the regular tax liability. And if you check the Internal Revenue Code wording on regular tax liability, it excludes any income taxable as FTAP to a non-resident under Section 871A. So, so there are two kinds of income that are taxable. I've made separate video series, four-part series on US taxation for non-residents. You can check that. Two kinds of income is there. One is the FTAP, that is interest, dividends, rent, royalty, everything. FTAP, flat 30%. Second is the ECI, which is income from any business run in the US, which includes personal services rendered in the US and all, including the rental property in the US. That is taxable as per the regular rates. So mostly when you return back, unless you have a rental property and all, that's a separate thing. You still have the US source income, wherein your AMT credits can be set off. But otherwise, there's very less chance for you to claim those, recoup those credits. So now in that case, the strategy that you can deploy, if you have significant AMT credits, which, and you have returned back to India and you are not sure what to do with these credits, some options that I will suggest is, first of all, you should have done what you should have done is that you should have, if you have a forward plan of returning back to India, you should exercise only a limited number of ISOs not to trigger the AMT, right? So it should be below the AMT exception threshold. That you should have taken care. If you could not, then, even so, suppose you are returning back to India. So this is 2025. You're returning back to India in this year. You can sell the shares, sell it in such a way in India, in US, that basically results in a gain, which qualifies you to recoup it from the AMT credits. One good thing what it does, one thing you can say that why to do it anyways, when I return back, then it will be tax free. One good thing is that right now, if you have a very big concentration risk, significant concentration risk in the portfolio, it gets eliminated when you, so you should try to eliminate it as fast as possible. So that is one strategy. You can kind of sell the shares, or you can take a disqualifying disposition with respect to the shares that you have exercised, the your options. You make a disqualifying disposition in the same year, which does not trigger the AMT. So that is something you can do. You should exercise at the start of the year so that you can plan it better. You have the whole year to plan, right? Then there are many other complex strategies which uh, cannot be mentioned in this video, cannot be discussed, very complex. And even some complex strategies I am also not aware of. I'm to be very frank, you can contact a specialized advisor, a CPA, who practices into equity compensation advisory, who can guide you better in such cases. Then there is one thing about realizing regular income in this year. So if you're returning back from US, and you have like a 401k or a traditional IRA, you can maybe make an early withdrawal. So whatever is the tax liability, the US tax liability that rises, that you can kind of set it off from the, so that you can recoup the AMT credits. So this is it. These are my points. So I hope this was useful to a certain extent. If you have AMTs, or if you have undergone this whole transition of returning back to India, do share your kind of inputs, your thoughts on this particular issue, which can help others also. Thank you so much for watching this video. Thank you so much.